That is my minimum threshold, is when I go in, I look for profits more than 2x, and I leave at the end of the day at least with twice the money that I put in. So whenever the leases end, the units will be turned. So it usually takes us a year to year and a half to get turned all the units. At that point, we choose to refi or resell.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 249. When you invest in a high-cost area, such as the San Francisco Bay community, you have to apply some serious out-of-the-box thinking to achieve profit in real estate investing. Over the last 6 years, today's guest has taken over 50 multifamily units from negative to high cash flow positions using the traditional BRRRR method as well as fix and flips in a high-cost area. Latha has been investing in multifamily since 2014, and she brings her experience as a data scientist and researcher to the finding, analyzing, and acquisition of commercial multifamily. Shree's specialties extend beyond real estate into statistical modeling, credit scores, and business strategies and development. She's also under contract for a hotel-to-multifamily conversion, which I'm looking forward to learning more about. Shree, welcome to the show.
Thank you, Brian. Thanks for having me.
Why don't you tell us a little bit about yourself and how you got started investing in real estate?
So thank you for having me again. And I am a multifamily investor based in San Francisco Bay Area. I've been investing for the last 6 years. My strategy essentially is to buy apartments that have rental upside. And I do 3 basic strategies. I do something called cash for keys, I construct ADUs, and I do layout changes. So those are the 3 big strategies that I implement. I sell my properties about a year and a half into rehabbing and completing the rehab. And sometimes I hold on to it, but I will talk more about when I choose to hold on versus when I flip. And I've been doing this for 6 years. And currently I'm in contract, like you mentioned, on the hotel to multifamily conversion.
Your 3 strategies are cash for keys, ADUs, and what was the third one?
And layout changes. So changing the layout of the unit itself.
Great. I want to talk about all 3 of those things. But I also, going back to your story and how you got started investing in real estate, I know that there's a backstory there that involves your husband. Do you mind sharing that with us?
Yeah, no, I'm happy to share. So it starts off sad, but it ends on a good note. So just disclaimer there. So in 2010, my husband actually went to work one day, and by noon he couldn't walk. And we found ourselves sitting in a doctor's office talking about, and she asked me, do you have disability insurance? And I was wondering, why is the doctor asking me that question? Turns out that she was expecting that he would be disabled in 5 years. So we were in a bad position at that point, and we were wondering how we can speed up our process towards financial independence in the event that my husband actually ended up being disabled. But the good part of the story is over the next year and a half, we worked really hard to help him recover. And he made almost an 80-90% recovery, and he's been fine ever since. We still have to manage the disease. It's not like something that just goes away. It's kind of a chronic problem. But he's gotten to a point where he's 90% better. And while he got better, the investments got better too. And thankfully, we didn't have to take much cash flow, so we kind of reinvested it back into the strategy and into real estate itself. And we were able to grow a lot faster.
Well, I'm glad that your husband turned out to be much better than the doctor anticipated. What was the disease that he's battling?
Yeah, so it's an autoimmune disease. It's called rheumatoid arthritis, and he still has it, but in a very mild form, and he doesn't show any, markers for it anymore. But yeah, he's all better now. and we couldn't be happier.
That's so great to hear. Now, you mentioned that when this happened, you started looking for ways to become financially independent. And I know as a data scientist, statistical, an analyzer, or whatever your title
Right.
is, you must have looked at a lot of different options. What led you to multifamily?
For me, what comes naturally to me being like in data is to look at data. So I look at leverage specifically. So leverage is what really brought us to real estate, because we could have run a business, but it's not passive enough, especially if you're sick, right? So so that was kind of ruled out. Is that if you're running a business that's actually time intensive, that's not going to work for us. Stock market was out because we couldn't buy with leverage. Maybe there are ways to buy in the stock market with leverage, but it's not accessible to the everyday person. Real estate was the easiest to access leverage to. And we knew that if we can come up with a down payment, we could buy some real estate. Then we kind of moved into the mode of, okay, maybe I knew for sure we can't buy single family because single family is terribly expensive here, at least in California. And but I still drove around, drove around neighborhoods looking for properties, and I found a three unit triplex in San Jose, and I went to take a look at it. This was 2013. So the first year of him being sick, we really didn't do much. We just survived. And once he started to get better, then we actually had time to actually look into investing. And we also were double income, no kids at that point. So we both had jobs, and we had no kids. So we had money saved up that we needed to invest. So I drove up to this triplex in San Jose, and I noticed it had it had 2 units in front and 1 unit in the back. And it had a whole little courtyard parking side kind of area in between. And it was kind of a waste of space. So I was like, maybe I can put a unit in here. So I went back to my Excel sheet and I put in another unit, and I just looked at the cash flow numbers and I was like, wow, this is way better. And then it clicked in my head when I saw that progression from adding more units, that maybe the strategy needs to be to get more units. And at that point, we said, you know what, maybe we just don't even buy in California. Let's just buy wherever we can buy the most number of units we can. And the first deal was always a little bit, it's kind of haphazard. We didn't go through any process. There was no coaches back then. There was no nothing, right? And so we just Googled, what are the top 10 markets for multifamily? And just kind of looked through the cities that really came up often. And I didn't really use any data science to pick the market. I just picked the market. And we picked Dallas, Texas. So our first investment was actually out of state, because we thought we couldn't afford California, and we had heard so much about California not cash flowing, and we didn't know any better. So we believed that stuff. And it's still not the best for cash flow. We all know that, and I admit that openly. But there are other ways to make money in California, and we'll get into that. But my first investment was out of state. It was a 12-unit apartment complex in Dallas in 2014, and we bought it for $728,000.
Yeah, so that was your first. It was out of state. I'd like to hear a little bit about that. I mean, what was it like buying that property out of state, not really having the boots on the ground there that you would have otherwise?
Yeah, I mean, I think it actually taught us a lot about how to truly be passive, because if we pretty much had bought in California, we would have been more hands-on than if it was out of state. So I think in some ways it taught us, in retrospect, it taught us how to put those systems in place and hire the right people and all of that good stuff to get that property stabilized. We knew that going in, we were going to do renovations. And I always say this to anyone who asks me out of state, is that the key to getting out of state working is to find a property manager that also has an in-house contractor that they work with. So those two things are not separate. They are managed together. And the property manager oversees the rehab work, and that they have a good relationship and that they can get the job done. So you're not in the nitty-gritty picking out appliances or paint or whatever, right? So, and most of the times we've just walked into a unit, looked at it. I like this one. just do this one on all the units. So we really don't go into the details of the units or the rehab too much, other than budget. Budget's the piece where you negotiate the most.
I agree with you on that. Finding a property management company that has the in-house maintenance, the in-house rehab team, that's key, because that way they're responsible for the whole process. And especially if you're investing passively from out of state, you don't have to go and find every single contractor.
Correct. Yes.
So that definitely helps. So how did it turn out with that 12 unit in Dallas?
Yeah, so we bought it at 720 something, and we put in about 140, and we exited at 1.35, 1.35 on that one. So we basically doubled our money. We put in about 350. We got out a little bit more than 350. So we basically 2x'd our money in about 1.5 years.
That's fantastic. Good for you.
Yeah, I mean, essentially that is my minimum threshold. Is when I go in, I look for profits more than 2x, and I leave at the end of the day at least with twice the money that I put in.
More than profits 2x in what timeline?
1.5 years.
Okay.
Yeah.
Okay.
Because whenever the units are turning, they're usually aggressive. I know we are more aggressive than the average investor. So whenever the leases end, the units will be turned. So it usually takes us 1 to 1.5 years to get turned all the units out of state, not in California, but out of state. And so at that point, we choose to refi or resell.
And I think it's evident that that was not a fluke, because I know you've done many deals since that Dallas 12 unit.
Right.
But you've also now kind of made it a specialty to invest in high cost areas like San Francisco Bay Area. Talk about that. Why are you investing in high cost areas where cash flow is so hard to achieve? And how are you able to maintain that 2x within a year or two process? So
the original motivation, I mean, there was no real motivation when we sold the property in Texas. We wanted to move that money to another type of property. It's just that that time when we sold, we had about $700,000 coming out of that property on the sale. So we could afford California when previously we couldn't. So that was very simply one of the reasons why we thought we wanted to come back to California. And we knew the market has huge job growth and and all of that going for it. So we considered California. And when we started underwriting deals in California, we noticed that there were things you could do. And at that point, I should mention that California was not under rent control. Not all areas were rent controlled, but as of 2020, all of California is rent controlled.
We should talk about that too, because I know that sort of changes the whole dynamic of investing in a high cost area.
Correct. Yes. But to be fair, a lot of the properties that I did invest were already rent controlled. So there were cities within California that were rent controlled, but now the whole state is. So
do you feel that the rent control is sort of a neither here nor there thing to you because you're already investing in rent control areas?
Correct. Yeah. So I'll talk about that and we go into that. So that's where
let's have that conversation now about rent control since you brought it up. But how does that skew the numbers?
It does. Okay. So what it brings to the table is what I call political risk, right? Rent control essentially allows the landlord to only increase the rents by 5% plus inflation or plus CPI. But in traditionally rent-controlled areas like San Francisco, Oakland, Berkeley, these are traditionally rent-controlled areas for like 30, 40 years, they've been rent-controlled, is that all the rents are depressed. Most of the rents are depressed, I should say. So we try to buy properties where rents are severely depressed. So if you had a one-bedroom that would rent out at $2,500 a month, under rent control, it's at $800. So there's pretty much almost $1,800 in upside rent that has not been tapped yet. So what we do is try to buy properties that are either vacant, which means you can go in and renovate at any time, or properties where the rents are severely depressed. And what we found over the years is that if you have a large enough number of units, about half of the tenants choose to take cash for keys. And we can talk about cash for keys. Cash for keys is essentially an agreement between the owner and the tenant, that the tenant will take a mutually agreed upon sum of money in return for giving you, the owner, keys for the unit that they have now vacated. That's what cash for keys essentially is. It's completely legal. It's been used, many, many times over the last few decades. And so essentially that is the strategy to get rent control to work for you, is to negotiate with the tenant a agreed upon sum of money in order to move out.
That's really an interesting way to profit in a rent control area where you're buying a property where the rents are so far under market, but they're locked by rent control, to be able to pay cash for keys to the residents to move on to a different place. How much do you typically end up having to pay them?
So this will give everyone else sticker shock, but in California this is normal. Somewhere between $10,000 and $30,000 is what you pay.
So you call them up, or you go knock on their door and say, "I will pay you $10,000 to $30,000 if you just move."
It is more nuanced than that, because most of these areas that are rent controlled understand that rent cash for keys is a strategy. So the city of Oakland, for example, has a very specific process you have to go through to be able to do this. So they have a disclosure form. Before you even start negotiation, you have to file that form with the city department. They have a rent adjustment program department. You have to file it with that department, and then you have to give a copy to your tenant. If they're interested in negotiation, they will get back to you, because they think, there's an element of, you don't want to harass your tenant. So anytime if the tenant says no, it's a no. There's no, you can't go back, in a month or so and ask them again. You have to wait 6 months before you can ask them again. So there's a very stipulated process that you have to go through in order to be able to do this right and not get yourself into trouble. So you can do that.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Does that present a certain amount of risk then when you're buying a multifamily? There's that risk that the tenants who are locked in at a lower rent rate just won't accept cash for keys.
Correct. And that's why it is a risk. It is a risk. For us at this point, it's a calculated risk because we've done it before and we know how to sort of at least estimate what percentage of people will move, especially as you get to larger units. If you're buying 2 units and both of them choose not to move, that's not good, because you'll be stuck with a property that's making very, very little money. But the one way that I'm encouraging people to structure their contracts, like when you're making an offer, is to put in a clause where you can start the negotiation while you're in your due diligence period. So you get a sense of how many people are likely to move with the permission of the seller. So you kind of put that into your contract, and that's one way to mitigate that risk even just a little bit. And if you happen to fall out of contract, it's still a win for the seller, because now they know that some of those tenants are willing to move out, and they can actually continue that process, or figure out another way to vacate the unit and now bump up their sale price. So it's kind of a win-win even for a seller to allow you to put that into the contract.
It adds a very interesting dynamic to the due diligence process when you're acquiring a multifamily, because now you have to take a lot more about the tenants' plans into consideration. Is this something that's commonly done by investors like yourself, or is this something that you figured out exclusively because you're a data scientist?
No, it is not I wouldn't say common, but it's not uncommon. It's one of those things, right? So the people who know. And so the way we found out was because the first deal we did, our property manager told us that this is an option for you, and we did pay out of our own pocket to do cash for keys. But over time, what we recognized was some hard money lenders or private lenders, we can talk about that too, do finance the cost of these buyouts 100%, kind of like they finance your renovations. Like if they say 80% renovation, and 80% of your purchase loan or something like that. Well, and so we were able to get 80% purchase, 100% rehab, and 100% cash for keys.
Yeah, it seems like you could classify it as either a rehab cost or a closing cost or whatever, and then build it into the amount you're borrowing from the lender, huh?
Traditional banks don't like it at all. They will not lend against for that purpose. But private money lenders will lend, and they will lend they will roll that into the loan, but they still classify it as cash for keys money. So they're well aware of the strategy, right? If they have an actual product for it. So it's not that uncommon that they don't have a product for it. So they definitely have a product for it. And so it's not uncommon. But a lot of investors that I talk to are not aware of it.
What type of lending are you typically utilizing?
I mean, we did do like a traditional financing on our first deal. We just negotiated like no prepayment penalty on the first one because we sold that in a year and a half, as I mentioned, in Texas. But once we moved back to California, what we found was all of these properties require heavy rehab, meaning they have a lot of deferred maintenance because nobody's if they haven't increased the rents and they pretty much have not done much to the property because they're not making enough cash flow from it to kind of improve the property or reinvest into the property. So these properties do tend to need a lot of work. And the only way we could finance all of that stuff and get sufficient amounts of leverage was to go private money, or hard money as they call it.
Private money being money from private individuals? Is that typically who you're going to?
Yeah. So what the private money, hard money guys do is they have a group of private individuals that pool the money together, and you borrow from that entity, and it's a high interest, but it has all these bells and whistles that work for investors. They have they provide almost 100% rehab, 100% cash for keys, and usually that ends up being somewhere 90% leverage overall, if you looked at all of it. And the interest rates are about 9%.
Are you doing 1031 exchanges as you go along?
We are not. One of the strategies we found almost by accident is that we always did that. We went through the 1031, process. So we did the 45 days and the 180 days, and we bought the new property. But what we found was that year when we were filing our taxes, because our rehabs tend to be so capital intensive, we were able to write off such huge losses against the gains from the property that we never had to do 1031.
So you weren't paying taxes on the profits in the first place because of your high expenses.
Correct.
Wow. Okay. That's great tax strategy.
That is. And we didn't discover it until we did it ourselves. And we figured out that, and so it helps us to do more rehab because all of that rehab money is financed. So our return looks way better because we get to take all of that rehab against, not all, but a certain percentage of that rehab against as passive losses, but all of that money was financed. So it's really a great strategy that also gives you tax benefits from it.
Well, I want to talk about ADUs because you've got three main strategies that you employ when investing in high cost areas. And we've already talked about the first one, which is cash for keys. And that's what a great strategy. I'm glad you shared that with us. What are ADUs and what kind of strategy are you employing there? Yeah,
so ADUs are accessory dwelling units. That's what they stand for. These have come up in California and I think other states, but you can correct me if I'm wrong. But essentially the cities have incentivized property owners to put small dwelling units in backyards or open areas of their property in order to provide more affordable housing and to kind of reduce the the need for more housing in high density areas. So pretty much all over Northern California, where all of the jobs really are, cities have highly incentivized people to put these ADUs in their backyards. And everywhere from single family to multifamilies can put ADUs in there. And there's all these, you have to kind of read through these ADU ordinances that tell you how many you qualify for. So we have 2 properties where we are adding ADUs. And the advantage of that in the big picture is you're adding more units. And on average, even if it costs like $150,000 to $200,000 to build a unit, if you can sell it at $350,000 a unit, you've already have a margin built in there. So that's really the play with the ADUs. Now, an even bigger hack on that is if you don't have to construct a new ADU. For example, you have a basement or you have a garage area where you can put a unit on top of that. That reduces your costs of adding an ADU, but you do add an actual unit to the property. So you're still going to get that cost per unit when you sell, but it didn't cost you $150,000 to $200,000 to build it out. Does that make sense?
Yeah, because the building's already there, so you're
already
just it's basically a conversion rather than a brand new construction type
Correct.
Project.
And that still qualifies as an ADU according to the city.
Great. And does it have all the plumbing and electrical that you would
You do have to do some of that. Yes, you will have to. It'll still cost you about $100,000 a unit, but if it's new construction, it's going to cost you $200,000. So it's kind of half the price, at least in our area.
Right.
So it'll reduce your cost by half, and you still get to keep the upside of the cost per unit when you sell.
So just for our listeners, ADU stands for accessory dwelling unit. And I know I've done a little research on this myself. I know that's a very hot concept in California because there are so many people looking for places to live, a real lack of housing there. And I know from living in Los Angeles, you see those all the time. You see houses behind houses behind houses. It's just it's all packed in so tightly, even in the suburbs there. So that's a great strategy. How many times have you employed that?
We are actually just doing that right now. So on 2 of our properties, they're being constructed right now.
Give us an example of how it's working on one of those properties.
Yeah, sure. So one of the properties is a triplex, and I'll give you a brief version of the other one, which is a 12 unit. The triplex allows for 2 more ADUs. So one of the ADUs is going in the basement of the existing structure, and the other one's going on top of another detached unit. We're going to add the second one on top of that. On the 12 unit property, we have tuck under parking. So like if you walk into a building that has only parking in the lower floor, that's called tuck under parking. And it's basically like, open carports. And so in what the city incentivizes you to do some earthquake retrofitting. So San Francisco is prone to earthquakes. And if you did that extra work for about $100,000, they give you 2 additional ADU units that you can build. So as long as you have space, you can actually even get rid of some of your parking to put units in there. So we're going to get rid of 4 parking spots, put 2 units in there, get rid of a utility room that no one was using, put another unit there. So these are the kinds of maximizations that we do to put those ADUs in there. And for the triplex, for example, an ADU costs about $100,000 each because they're already basement and already the structure already exists. So they're about $100,000 a unit.
So talk about the economics of that. How much are you acquiring that property for? How much will you put into it to add the ADUs? And then what will it be worth when that's all done?
So that property was acquired the triplex was acquired for $1 million. And I'll be renovating the other units too. And we got this one was completely vacant. We are going to renovate 3 of those units at about $30,000 a piece. So we do a full gut reno. So we converted a 1-bedroom to a 2-bedroom. So this kind of bleeds into my other strategy, which is the layout changes. So we converted a 1-bedroom into a 2-bedroom. And then the rest of the units, we just rehabbed at about $30,000 a door. And the ADUs are about $100,000 a piece. And at the end, so that's about $290,000. So I'll end up at about 1.3 on that, and I'll be able to sell at 1.8. So that's kind of the spread.
Nice. So you'll make $500,000
Correct.
off that. That's fantastic. And you brought up the third strategy, your core strategy that you usually use, which is layout changes. Talk about that. What are some of the layout changes that you've employed to add value?
When I say layout changes, I mean you keep the existing most likely, if you can, you keep the existing square footage of the unit, but you change the layout of the unit. So I've even done it for studios. So I still have that property. The square footage is about 450 square foot for the studio. But when I walked into this unit, like when I first bought it, it had a detached kitchen. Like the old school style where the kitchen is a separate room, but everything else is another the living area. But what kind of struck us was nobody wants detached kitchens anymore. People want like the open floor plan. So we took the square footage of the kitchen, we converted the kitchen to an open concept kitchen. We took the square footage from the old kitchen, added a bit more from the living space, and made a bedroom out of it. And the moment we did that, the rent goes up an extra $300 because the studio rents are very different from a 1-bedroom rents, even if that 1-bedroom was really tiny, right? Because people value that separation of a bedroom versus a living room. And simply by doing that, we were able to get $300 more in rent than we would have gotten as a studio.
That's great. Have you done other layout changes?
Yeah, like I mentioned, we've done the 1 to 2 bedroom. Also similar we kind of used the kitchen space to add the extra bedroom pretty much. And then we put the kitchen kind of in the living portion of living area.
How do you arrive at these creative strategies? Do you consider yourself a creative person and investor, or have you learned these along the way from coaches and instructors?
Yeah, that's a really good question. I think I know. So there was a book back in the day that I read. It's by an author called John T. Reed. He's a California investor. He used to invest in the 1970s. He's like a West Point and Harvard graduate, and he's written a bunch of books. But he has one book on value add, which is really just the craziest things you can think of to value add. And I think just reading that book just puts ideas in your head that you would never have thought of. So we read that book, my husband and I read that book back when we were first starting, like 2013, 2014. And that made us kind of really forced us to think out of the box. And that definitely helped when we brought our money back to California to invest, because we had to do something. Like if we underwrote it in the traditional way, if you just took the EOM and plugged in the numbers into your Excel sheet, it would look so terrible that you would never even attempt to to buy it, which is what 90% of the population does and says you should do, which is don't ever invest in California. It's a waste of your time. But if you start to question each line item of your underwriting and ask yourself, is there a way to actually get higher rents? And what can I do? Is there a way to lower my expenses? And why are the expenses so high? And if you understand the local laws, that helps a lot. So you really have to think a little bit out of the box to make it work really in these markets.
And what was the name of that book and author again?
How to Add Value to Real Estate, John T. Reed.
So now that you're investing in somewhat of your own backyard in the Bay Area of California, and comparing that to your passive investing experience in Dallas, are you a lot more hands-on now, or do you have systems in place that allow you to do all this passively?
I mean, we are more hands-on than we were on that first deal, but we still do have systems and processes. So we still hire contractors who we don't have to manage too much, and that they manage the permitting and work well with the property manager for oversight and all of that good stuff. We do tend to, especially with COVID and things like that, we are kind of, you do have to be a little bit more hands-on, make sure your leasing is on point, because it's much harder to lease given the current environment. We do, but we don't, it's still passive, end of the day, it's still passive. And we are now focusing our efforts really more on our how do we grow from here? How do we get more cash flow? Because I think what we've learned over the last 4 or 5 years, just from investing in California, is that it's great for capital appreciation, meaning all of the stuff that I'm talking to you about, cash for keys, ADUs, they all increase your equity in the property by significant amounts, but your cash flow is still not as great as it should be, right? So your cash flow is still, it's not as great as if you took all that equity out and invested it. So your marginal return on your equity is still low because the cash flows are still not as great. And so we have decided to keep some property in California for appreciation potential, for, almost like a test, right? Almost like a test to see 10 years, 20 years from now, which one do you think was going to outperform, right? So let's keep some here as long as we can, which we can afford to do now, because when we did the whole private money leveraging our cash strategy, we were able to open multiple lines of such properties because we're not taking it exactly. It's not linear, but I took the money from Texas, put it into one property in California, and then I had to sell that one to get to the next one. I was able to tap into equity from refinancing some of these and start off new chains that then started to multiply. So we do have the ability to hold on to some in California, so we're keeping a few, but we did sell a few last year, almost half actually of our portfolio last year, and we're looking to move that out of state.
So you're going to test whether buy and hold in California, where the cash flow is minuscule, works better than buy and hold in other areas where the cash flow might be higher?
There's a correction there, right? So we're not doing buy and hold, we're doing buy, rehab, and hold in California. So we have a lot of equity and a lot of leverage. So cash flow is still good at that point. It's just that I'm not tapping the equity out of it and forcing it to cash flow less. So I do have equity in it. It's cash flowing reasonably well. But it's not, it would cash flow more if I took it out. But I wouldn't know the future potential of that property if I didn't hold on to it. So I'm going to hold on to half of it, half of my portfolio, and the other half is going out of state to make more cash flow.
What does the side of you that's a data scientist and statistician think about that? Like, where do you think the real profits are?
I think that there's actually a very simplistic way to look at it, right? I don't try to project or try to, predict what 10 years from now is going to look like. But for what I do recognize is really understanding how the exponential growth within real estate works. And I really try to focus on that. Essentially, what I'm trying to say is the first few deals, your money has to grow exponentially before you can say, I'm going to sit back and enjoy my cash flow. And that's the case for 90% of the people. But for some reason, we get stuck into choosing between cash flow and appreciation, when actually my recommendation is you have to force the appreciation by doing all of these value add strategies a couple of times until your equity is built up to the point where you can then choose to go take the cash flow from a market that may not grow as much, or you can choose to keep the cash flow from California, because my properties are still cash flowing really well, like better than any passive investment could. But but that's because I grew my capital exponentially over the few short years that I've been doing real estate. And once it hit a point where I'm cash flowing $100,000 a property, then I stop. I'm not flipping anymore.
Then you can just go to hang out at the beach and relax for the rest of your life, huh?
Pretty much, right? I mean, California costs a little bit more than $100,000 to live in, but at least on one property, if I can bring that to $100,000 in cash flow, I don't sell that property. But if it's too small for, like if it's only cash flowing $30,000-$40,000, then I take my down payment out and my profits out, buy a bigger property, and then now I'm taking 1x and making it 2x and 2x, 4x, right? If I do the BRRRR, I take 1x, make it 2x, take out 1x, again make it 2x. So it's not exponential growth, it's kind of linear growth, right? You can only do one deal at a time, and you're only going to grow 1x to 2x. You're never going to grow 2x to 4x, which is what I recommend you do a couple of times before you can start to do the BRRRR. So I call that flip BRRRR.
So you and your husband are starting on a new project, hopefully. I mean, you've got a hotel under contract. Can you talk about what you plan on doing with that?
We are, buying a hotel that's probably built in the 1970s. And this is a strategy. We're looking at multiple hotels, multiple different markets. So we're looking at an older hotel that is now not operating at its peak capacity. It's not doing much in terms of revenue and cash flows. And what we're looking to do is to buy that property, go through the city to convert it to multifamily, put kitchens in the unit, do whatever the city asks you to do separately, meter it, all of that good stuff, put sprinklers, all of that good stuff, and turn around and sell it as a multifamily at the end. So all of the hotel rooms will be converted to like studio units at the end of the process.
That sounds like a massive undertaking. How many units is this hotel, and how much? Talk about the economics of that. How much how much rehab?
These are in relatively affordable markets, like in the middle America. So we are in contract for $2 million, and we have about $1.5 million in rehab costs going into the property. It's 115 units, but we do have to, per the city, bring it down to 100 units in order to, qualify for all their requirements to convert it to multifamily. It is unique in the sense that we don't need to really do a rezoning. So a lot of these properties were zoned for a hotel. So you can't just walk in there and convert it to a multifamily. You have to kind of go through the city to change it. But what we've done is we've tried to identify properties where the zoning allows for both. The zoning has multiple land uses that allow you to do hotel or allow you to do multifamily both. Now, by that really whittles down our deal population to a very small number. And then we have all these other constraints of they need to have enough parking and all of this good stuff. So we really narrowed it down to a very small number of properties, and then we have our broker negotiating with them on those deals to get more in the pipeline. But the upside really comes from the number of units, and the ability to. So if, for example, we're acquiring some of these hotels at $25,000 a door, we put in about maybe another $25,000. Another $20,000 a door. 10 in interior rehab and 10 in all this exterior stuff that needs to get done. So put in about 20, and you end up at 45, and you can sell at about 65.
Okay, nice.
So about 10 to 15,000 a unit in profits. And multiply that by 100, that's about $1.5 million in profits.
We're recording this in June of 2020, so we're in the middle of coronavirus. And a lot of people are starting to think about that strategy because you see that the hotel industry is really being hit hard by this pandemic. So the anticipation is that there will be a lot of hotel conversions like what you're talking about on the horizon. Is this something you began before coronavirus, or is this a result of coronavirus?
No, it is actually something that I began before coronavirus. So we sold most of our properties in October last year, and we were looking for replacement properties, and we underwrote a lot. So we underwrote a lot of properties, and we did see profits, but we were always not happy with how much we were looking to make on the upside. So I personally met with this lady here in California. She does hotel rezoning, basically hotel entitlements. That's her business. And what she does is she buys retail. So she buys retail land, like a store that went out of business, for example. She buys that piece of land and she spends about $1 million to convert it from its current use to a hotel, rezones it to a hotel, re-entitles it for a hotel. And she doesn't do any construction. She just sells the paperwork to a hotel chain, to like a Marriott or a Hilton, who would then buy that from her. So she's literally just like pushing papers through the city and doing all this work, of course, to get architects and all of that stuff lined up. But I really, once I understood that business and I saw the potential spreads in that business, I was sold. Because rezoning is one of the most profitable things you can do in real estate. And the guy I mentioned who wrote the book, John T. Reed, he says that too. It's one of the most profitable things, but it's also one of the most risky things to do, is rezoning. So even though the upside exists, you really have to figure out ways to de-risk some of those aspects of the rezoning process. And I learned about how she does her business. I cannot do that business, but I could, and I know multifamily better. So I kind of just made that work within the multifamily space to say, how can I make this work for the strategy that I know well? And I know people have done this for assisted living. People have been converting hotels to assisted living facilities for decades. So this is not new. And I'm pretty sure even the hotel conversion is not new. It's just that it's new to me. And we've even found banks who financed this kind of conversion before. So they're familiar with it too.
Where is this and how did you identify this location?
Right now we're looking in parts of New Mexico and Florida. And what we didn't, how did we, it just, so it's funny. I think the first deal was just by chance. We had a broker who brought a deal to us that on our table, basically, that had half of the property zoned for multifamily. So it had 2 parcels of land. One was already zoned for multifamily and one was hotel. So that, that brought back all these thoughts we had about, rezoning and land use. And we said, what would it take to change the other rezoning to multifamily as well? And that deal never materialized. It kind of fell through. But we figured out enough in the process to understand the local laws. And there are consultants who know the stuff that is specific to that local area. And so we hired them to help us navigate this process to narrow down which properties fit into this criteria.
Where is it then? Where is this?
In New Mexico, it's in Albuquerque. In Florida, it's in Orlando.
Okay, so these are two. So you have 2 of them that you're.
Yeah,
Gotcha.
correct. So one is in contract, the other one is almost in contract. We had inspections and stuff. We just walked through the property, so we're very close to being in contract, not in.
You're both a data scientist and a creative real estate investor, and you've applied both to your strategies and been quite successful at it. What do both of those sides of you tell you about the future of commercial real estate investing as it stands right now? Like, where are the opportunities and what should we avoid?
I do think at an individual level, it definitely helps to be comfortable with your numbers, right? Because I think for most of my deals, if you looked at anything that I've worked on, the deal economics makes more sense than the market economics, right? So there's a lot of multifamily investors who focus on finding the right market, right? And they spend a lot of time trying to figure out the right market. And I do think there's value in that if you're going to do buy and hold, because you don't have much of a buffer when you're doing buy and hold. You're really just operating under a thin margin of cash flow, and you want the market to appreciate in order for you to get profits. But if you kind of bake in your returns using a forced appreciation model, you have a lot more room to work in. So to go back to your question, it really comes down to being comfortable with number crunching. I really think at an individual level, that is a skill that has been worth a lot more than I can articulate. Because every time someone tells me I'm confused about even for example, COVID, right? What is the effect of COVID on doing deals, right? You can model that. You really can. You can say, what if my exit cap rate went up, 2 points, right? And then my kids say today my market cap rate is 6 cap, and maybe when I sell it's going to be 8 cap because I think the market's going to be in real trouble at that point. You can model that. You can do a sensitivity analysis. You can do, there's many ways to quell that fear into a spreadsheet and actually just look at it and say, what is my worst case scenario? And is my worst case scenario still okay with me? And if it is, then there's no reason why a market should stop you, or coronavirus should stop you, or anything really should stop you. So that has been my take on it. You need to still have your cash reserves and, all of that good stuff, the traditional real estate advice, all of that is still valid and very important. But at the same time, I do think that it helps to go internal a little bit. So instead of seeking advice from gurus to teach you how to do stuff, maybe just take a second to start with a blank Excel sheet and just plug in your own numbers in there. Don't use anyone else's calculators. Just put your own numbers in there and see how a deal works out. And sometimes just doing that gives way more clarity than trying to piggyback off an existing strategy.
Shri, how would someone get a hold of you if they wanted to do so?
I do have a website. It's called the SriLathaGroup.com. So it's the Sri Latha, SRILATHA group.com. I'm also on Instagram as Bay Area _multifamily. My email is shri@srilathagroup.com. So you can reach me in any of those places. I look forward to connecting with your audience, and we can talk more about being part. I do actually have a coaching program that I do for a small group of investors. And if you would like to be part of that, you can reach out to me there as well.
Is that coaching for people in the Bay Area, or is it nationwide?
It can be nationwide. It just tends to be that the people who've started the program with me tend to already be in the area because they want to learn that specific strategy. But I do have a couple of clients who are in the Carolinas and out of state as well, who are looking to learn from me, but still think out of the box even in those areas.
Well, Shri, I want to thank you for having this conversation today. First of all, I love talking to people who love data and numbers, and I appreciate your perspective there. But I definitely appreciate your creative investing perspective and the 3 strategies that you're using. The cash for keys, ADUs, and layout changes. I think all 3 of those are great strategies, especially in the rent-controlled and high-cost areas that you're investing in. So thank you so much for telling us about them today. It's been a pleasure talking with you.
Thank you, Brian. This was wonderful.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.